Hello again, this is Kirk Lynch, and today's lecture is going to focus on accounts receivable and various methods for writing off uncollectible accounts.
The assumption to this point is that every customer that owes us money will pay us. This is not a realistic assumption, and there will be accounts that cannot be collected for various reasons that need to be written off. Since we record the revenue when it's earned, we need to create an expense for those accounts that will not be collected and written off in future accounting periods. There are two ways to do this: the direct write-off method and the allowance method. The direct write-off method, we write off accounts as they become uncollectible. The journal entry to do this is to debit bad debt expense, or uncollectible accounts expense, and credit the accounts receivable account. Make sure you update the accounts receivable subsidiary ledger to identify the individual accounts being written off. The direct write-off method of dealing with uncollectible accounts does not conform with generally accepted accounting principles because it violates the matching principle. You may recall from previous lectures that the matching principle states that revenues are recorded in the period in which they are earned and expenses recorded in the period in which they are incurred. Due to the nature of collectibles, it's very likely that revenue recorded in one accounting period may not be due for payment until a subsequent accounting period. Even those accounts that are due in the original accounting period may not be paid. In other words, they are past due. Accounts past due may not be written off for several months as collection efforts proceed. It is only after these collection efforts fail that the account may be deemed uncollectible and therefore needs to be written off. It's easy to see how revenue from one accounting period may become an expense in a subsequent accounting period. The allowance method of dealing with uncollectible accounts addresses this matching principle violation. More about the allowance method in a few slides. The direct write-off method can be an acceptable alternative under certain circumstances. Many businesses do not deal in credit accounts, for example, attorneys, catering, convenience stores, and others, and on rare occasions that one of these types of business should offer credit and it becomes uncollectible, the direct write-off method would serve this need. Assuming the direct write-off method meets the needs of a business, the following are examples of journal entries used to write off an account, reinstate an account that was previously written off, and to collect the money. To write off an account, we debit bad debt expense and credit accounts receivable as we stated previously. If the account should become active subsequently and collections are now possible, there are two entries that need to be made in the journal. One, to reinstate the account, which is shown above, debit accounts receivable and credit bad debt expense. And then second, a journal entry to collect the money, which is a debit to cash and a credit to accounts receivable. The preferred method of recording accounts that have become uncollectible is the allowance method. The allowance method fulfills the matching principle by correctly matching expenses with the revenues that are generated in the same accounting period. The allowance method requires that an educated guess about the amount of outstanding accounts receivable that will not be collected. More about this guess in a future lecture and how that guess is estimated. This estimate will generate an adjusting entry at the end of an accounting period which will debit bad debt expense and credit a new account called allowance for doubtful accounts or allowance for uncollectible accounts. This new account is a contra asset account that performs much like the accumulated depreciation account that reduces the overall value of the asset by the amount of the contra asset account. Here we see a balance sheet that shows our current assets. Included here is accounts receivable and the new contra asset account, allowance for doubtful accounts. These two accounts are netted just like the equipment and accumulated depreciation on equipment that results in the book value of the equipment, only now we call the resulting netting of these two accounts net realizable value, highlighted here in red. So the addition of this new account adjusts our accounts receivable and consequently our total assets down by the amount in the allowance for doubtful accounts account. The allowance for doubtful accounts is then used to write off uncollectible accounts receivable as they become deemed uncollectible in future accounting periods. Now back to the process of writing off accounts using the allowance method. There are basically 3 steps to writing off accounts using the allowance method. Step 1 is to calculate the guess for the uncollectible accounts that will be coming in future accounting periods. An adjusting entry is made to match the expense in the current accounting period. For now, this calculated number will be given, but we will learn 2 methods to calculate this amount in a future lecture. Step 2 is to make the adjusting entry. A sample is shown here on the next slide. And then step 3 is to write off the accounts as they become uncollectible. Here we see a sample adjusting entry. It is determined in this example that $5,500 will be uncollectible in the next accounting period, and therefore we debit bad debt expense in the current accounting period and credit our new allowance for doubtful accounts account to use in the next accounting period to write off accounts as they become uncollectible. At this time, we have no idea which of these accounts we will have to write off. We just know from past experience that approximately $5,500 of accounts receivable will not get collected. This estimate will most likely be off a little as there are various factors that contribute to the collections that are out of our control, for example, the economy. In bad economic times, uncollectible accounts may go up. Our guess should be based on the best available data to closely estimate the expenses that we ultimately will experience. As accounts become uncollectible, we will enter the journal entry below to write off a particular account. In this example, XYZ Company owes us $400, and it's been determined that this amount cannot or will not be collected, so that we need to get the account receivable off our books. To do this, we will debit the allowance for doubtful accounts for the amount owed and credit accounts receivable, in this case, for $400. If for some reason in the future the XYZ Company decides to pay the money that they owe us, we can reinstate the account and collect the money using the 2 journal entries shown here. Reinstate the account receivable by debiting accounts receivable for XYZ Company and put the money back in the allowance for doubtful accounts to be used on some other uncollectible account. Then second, enter the journal entry to show the money being received with a debit to cash and a credit to accounts receivable for XYZ Company. Our goal with this educated guess is to provide exactly the amount needed to cover the write-offs that will be necessary in the next accounting period. This idealistic goal is rarely achieved, but is a good one nonetheless. As the next accounting period passes and more accounts are written off, the balance in the allowance for doubtful accounts is heading towards 0. Unless we have guessed exactly right, which is not likely, we will have either a debit or a credit balance at the end of the financial period. This slide shows a T account representing the allowance for doubtful accounts. The initial guess of $5,500 for accounts that would have been written off in future accounting periods would be entered as an adjusting entry, and the credit to the allowance account, as we see here, throughout the accounting period, we have several write-offs that have occurred. A $2,000 write-off, a $50 write-off, a $350 write-off. And then we see that the $50 account was subsequently reinstated and has been collected. So we put that money back into the allowance account to be used to write off other accounts in the future. And then subsequently we've written off $550, $1,900, and $200. And as we near the end of the subsequent financial accounting period, we see that the balance in the allowance account is a credit of $500. The following slide summarizes the meaning of the balance in this allowance for doubtful accounts account. If our guess had been exactly correct at the end of the last accounting period, the balance in the allowance for doubtful accounts would be 0. If our guess had been too low and we had written off more accounts than we had anticipated, the allowance for doubtful accounts would result in a debit balance at the end of this accounting period. On the other hand, if our guess had been too high and we had written off less accounts than we anticipated, the allowance for doubtful accounts would result in a credit balance at the end of the accounting period, as we previously demonstrated on this previous slide. In summary, the allowance method complies with the matching principle. It requires an educated guess to establish the allowance for doubtful accounts in the approaching accounting period, and it uses the allowance account to write off bad debts as they become uncollectible. This concludes our discussion on the methods of writing off uncollectible accounts and the determination of net realizable value for our accounts receivable. In our next lecture, we will learn how to determine the amount of the adjusting entry, or our guess, to fill up the allowance for doubtful accounts account to be used in the next accounting period. I look forward to seeing you then.